In recent years, the word debt has gotten a bad reputation, but the truth is, not all debt is bad. Some sorts of debt can be beneficial as well. Do you know that good debt is one of the finest methods to begin leveraging the power of your money? It can create passive income streams that will help you develop true wealth. No wonder rich people use this secret ingredient to become wealthy. It may surprise you that without debt, only a handful of people could afford to buy a home or use their wages to begin creating their empire. It's a no-brainer that wealthy people use debt to increase the returns on their money through low-interest loans and asset control. If their credit line is big enough, their capital and assets are used to get loans that they can use to invest and run their businesses. But do you know what the best part is? Their assets can make money while the borrowed money is also making money, adding to their net worth. Intelligent choice indeed. Today's video will examine how debt has helped rich people generate wealth. Let's jump right into the video, but before we do, remember to like this video. Let's get started. Number 1. Use debt as leverage to grow wealth. Rich people borrow because they desire to enhance their overall financial status, which they can do by leveraging the funds provided by lenders. You can do the same thing. For example, a wealthy individual may take out a loan to purchase an investment property that generates a steady income and appreciates. As the value of their assets rises, so will their net worth. Wealthy people may also choose to borrow to use their resources better. For example, rich people frequently obtain mortgages. This is due to low interest rates and the fact that interest is tax deductible. That's a smart move. Rather than investing their money in a property, people can receive a low interest loan and put their money in assets that yield a higher return. Here are a few ways leverage can help you. Let's find out. Leverage in real estate. With monthly payments and a 5% down payment, you can multiply your capital. A real estate investor with a $10,000 down payment can acquire a $200,000 home with a $2,000 monthly payment. So what's the advantage? Real estate investors earn returns on the entire loan amount, not just the money they put into the investment. Now, consider if the property's value rises by 20%, from $200,000 to $240,000. The $10,000 down payment generates a 300% return combined with a $40,000 investment return. That's undoubtedly amazing how things can add up quickly and make a fortune for you. Rich people do know how to turn the tables in their favor. Another way debt can be used is by purchasing monthly rental properties or residences such as Airbnbs. They help generate cash-flowing assets for monthly income through leverage. Similarly, the cash flow returns are based on the total debt, not the money put into the property. This makes far greater returns. Margin investing with leverage. Investing on margin allows you to purchase more shares than you have available funds for. For example, if you have $50,000 in your standard brokerage account, you could leverage your investment and open a margin account. A margin account allows you to deposit up to 50% of the stock's purchasing price. You would have $50,000 in cash and a $50,000 loan from your broker. Your $50,000 investment offers you $100,000 in purchasing power. You may use this money to purchase $100,000 worth of shares. If the stock price rises, you can repay the loan and pocket the profit. However, beware the disadvantage is that if your account's equity falls below a specific level, your brokerage firm may issue a margin call. If you cannot make your margin call due to a lack of funds, your broker may liquidate your entire position in stock, leaving you with losses. But for now, let's focus on the brighter side, shall we? Leveraged buyout. A leveraged buyout, or LBO, occurs when a company's buyer or purchasers incur significant debt as part of the purchasing process. The buyer will use assets from the purchased company as security to acquire the company, with the plans to repay the debt after using future cash flows from the company. The buyer gains control of the target company via a leveraged buyout. Short selling. Short selling reverses the regular order of buying and then selling stocks. Selling short involves selling something you don't own. When you sell a stock short, you borrow it from your broker and sell it to a buyer. You must then pay the broker for the shares. You receive cash from the sale, but that must be used to purchase the shares later and repay your broker for the loan of the shares. In a short side trade, you are long the cash and short the shares. Since you used credit from your margin account, you're in debt for the shares. We hope you understand the concept here. When you buy to cover the short position, your debit purchase price will be used to buy back the shares that you were shorted in the open market and your broker will be able to return the shares to the account from which they were borrowed. Today, everything is done electronically. A short seller trades in the other direction, selling early and then buying back later. You make a profit utilizing debt if you sell short at a higher price than you purchase it back later. When shorting a stock, you must pay margin interest. You will also be required to pay any dividends due on the stock during the period which you are short. This is how traders can profit on both sides of the stock market when it goes up and down. Leveraged ETFs. Next in the list, we have Leveraged Exchange Traded Funds, or ETFs. It enables investors and traders to increase profits by going long or short on a specific index. Using these funds, you can invest in specific indices, bonds, commodities, or sectors. What makes them appealing is the enormous profit potential of leveraged ETFs. During market booms, leveraged ETFs can provide returns that most investors only dream about. The issue is that leveraged ETFs can operate against you in the same way they work for you, but you can certainly play the game if you're a pro, and then keep your fingers crossed and hope for the best. Hedge funds. Some of the largest users of leverage are hedge funds. They're well known for generating exceptional profits through the use of leverage. Many hedge funds leverage up to 10 times their total assets. It would surely surprise you that billionaire hedge fund managers like John Paulson have turned accredited investors into multi-millionaires by using leverage. But one thing you should remember is that if the hedge fund manager investor's thesis is incorrect, the hedge fund will fail and all investors will lose money. Forex Trading. Forex trading allows investors to control enormous amounts of currency with small amounts of money. Currency traders can leverage their accounts 100 times. It can quickly turn small amounts of money into large quantities. Do you know that George Soros is the man who broke the Bank of England because he made $1 billion by betting against the pound? Precautions must be observed because risks are also there with such high rates of return. Margin account. A margin account is a brokerage account in which the stockbroker lends the investor money or shares in exchange for the investor's account as collateral to purchase securities. Margin trading is when your broker provides purchasing power to your account to increase the amount and quantity of trades you can make. Investors and traders can usually double the size of their total trade positions with margin accounts, as long as the stocks they buy can be used for total margin. More crucially, margin enables day traders to keep their purchasing power without waiting for all their trades to clear. Number 2, diversify the investments and spread the risk out over many different investments. Another advantage of debt is that it may be used to diversify your portfolio. When you're first starting and establishing your wealth, you may want to put the majority of your money into one investment to earn a high return and increase quickly. However, if you put all of your eggs in one basket, that may be too dangerous. What happens if something goes wrong? A stock market meltdown might cause the value of one investment to fall dramatically. If this happens, you could lose everything in an instant. This is where diversification comes to the rescue. Diversification means spreading risk across numerous investments so that no single investment bears all the risk and profit. Diversification can assist in avoiding this situation by spreading investments over many industries or regions. For example, you can invest in different stocks rather than investing everything in just one type at a time, which means less risk overall. Number 3, leverage time and experience. Debt can also be utilized to leverage your time and expenses, which is how wealthy individuals generate money. One example is when a wealthy individual borrows money to purchase an investment property. They then rent out the property for revenue. Still, they don't have to spend much time maintaining it because they've hired a property manager. And he is the one who handles repairs and upkeep and other aspects, making the rental operational and profitable. This means the rich person's time isn't spent on everyday activities like cleaning or dealing with tenant issues. Instead, they spend their time wisely on their business or other interests. Number 4, use commercial loans for your business. Suppose you have a business or are beginning with a well-developed business strategy ready to implement. In that case, commercial loans may help you start or grow your firm without emptying your current cash reserves. To acquire a commercial loan, you'll need to build a relationship with a local bank lender or an expert who can assist you in applying for the loan. While these loans are specific to your company, financial state, and plans, they might be advantageous because they allow you certain liberties. You should be able to purchase better company equipment and inventory. Commercial loans will also enable you to pay your first employees more to hire high-quality candidates. Remember to gain tax advantages by deducting business expenses. Lastly, you should be able to borrow adequate money to pursue commercial success while keeping your own money for personal use. Number 5. Get an education with student loans. You might be surprised to see this kind of debt in the good list, but it's true. Student loans can be an investment in your human capital, which is a valuable asset. In other words, they assist you in improving yourself and your skills. When you invest in education by taking out student loans, you unlock the potential to pay off your loan in the future with funds that will likely be worth more later. Higher education can also raise your earnings, which means you'll be able to pay off student debts with greater ease in the future if you plan correctly. Do you know how billionaires make ends meet? Consider Elon Musk as an example of a wealthy individual who makes money from debt and optimizing his tax liability. When the world's richest man needs money, he can borrow it and use it to cover living expenses. He can use his Tesla shares as collateral for credit lines instead of selling them and paying capital gains taxes on the earnings. His pledged shares of Tesla work like a loan, giving Musk access to billions of dollars whenever he needs them for any reason. Conclusion. Because all debt-based investment strategies contain some risk, it's important to research which method is best for you. Remember to take on only what you can afford to repay. Remember, when appropriately managed, debt can help you accumulate enormous wealth over time. That's all, fellas. We sincerely hope that you found this video useful. Remember to give this video a thumbs up and subscribe to The Growth Mindset. Do let us know which way of making money intrigued you the most. Thanks for tuning in.